Hey traders, I was just asked to look into the TLT trade. I have a few really important notes about the TLT that I will share in the write-up tonight, but this is different. This is just trading the TLT. Now the TLT is the basically the bonds. When you hear somebody says bonds are rising, that's an ETF that mimics the bond market. Okay, and it's a good gauge to see where debt is going, and usually when markets freak out, this rallies a little bit because it's somewhat a safety haven. If money is not going into stocks, it runs out of stocks and has to run into gold and bonds. That used to be the case. Well, now bonds are in a bubble because there's no reason why they should be interested in them, and rates are rising. So when rates rise, the bond falls. This is always the case. It's an inverse relationship. So in this case, the experts have been calling for a debacle in bonds for a long time. I mentioned this because it's important to the trade. Now, hasn't happened. I mean, they've been saying this for over a year. I can't remember when, but definitely over a year. I mean, people that like Bill Gross, who's known to be the huge expert, let's put it this way, in bonds. PIMCO, he was PIMCO, and then he split off of them. So it is in a bubble. When will it burst? I don't know. So I shared yesterday a TBT chart, which is the inverse of the TLT. The TBT is an ETF that basically is the rates, where the TLT is an ETF, which are bonds. So they move in opposite directions. I showed a potential of a breakout in rates via a super breakout in the TBT. Today I want to show, well, the question is, that can I go along the TLT here? Actually, how do I go along the TLT? They want to go along the TLT. This is somebody who benefited from profiting in a spike in the TBT, so they booked their profit there, and now they want to take the opposite side. So they're going against what the other people are doing. So I can't fault them for doing that. They profited. Now they have profits in hand. They want to take the opposite side. So they profited going this way by going along the one that moves the opposite way. And now they want to go along this guy, which has been selling. Okay, this is TLT. This is bonds. So the problem with me going along here is fundamentally speaking, technically speaking, I should say, sorry, I shared the fundamental already. They should be falling. Rates are rising. These should be falling. And the problem is now they've had a poke, two pokes, and here's a third poke on it. Now it looks like a head and shoulders. Now it's not perfectly a head and shoulders, but a head and shoulders in spirits, I'll put it in plain simple English, is they form a shoulder. You know, bulls rally, bears bring them back to a neckline. Bulls say, we can do this. They get a little bit higher, and bears say, no, we can put you back to where you came from. And then the bulls say, I can do this again and beat you this time. Bears say, no, definitely not. And usually this is one head, one shoulder, one head, one shoulder. Now these are almost all the same size, but they come back to the same neckline. So if, that's a big if, bears prevail and they break through the neckline, they overshoot lower to about here, eyeball. Why do I say here? Because this was the last bounce area. So the opposite side, what this member is saying, that they foresee a bounce here. Instead of a bears prevailing, the bulls are going to prevail again, which is entirely possible. So if that happens, then a bounce in bonds will ensue, and then maybe we top out here again, but it doesn't matter. They'll make money on this bounce. So ways to do this: I would buy a call spread. Buy a call. That's the most aggressive because I'm laying out money, and the money I could lose all the money pretty quickly if price falls down. I can buy a call spread, meaning I buy a call here, I sell a call higher. If price moves through both, I profit. Otherwise, I lose my money, but not as fast as buying a naked call. Now, I can do a credit put spread, meaning I take a risk down here, say, okay, I'm going to sell some spreads here. Basically, I'm selling a lottery ticket to somebody who thinks that bonds are coming down here. And if I'm right, they lose their money because the lottery doesn't pay for them. It's a loser for them, but that's how I designed it. So I collect the premium. Premium goes into my account. Time passes. If I'm right, and even if I'm wrong and price didn't hit me, then I keep the premium. They lose. This credit put spread. I can sell puts, but yeah, I wouldn't do that. Naked. So credit put spread, that brings in money into my account. Either of those two situations are bullish. I want price to either, well, in this case, I want price to not fall or rise. In this case, I need price to rise. Or I can do both. That puts me really bullish, TLT, meaning I collect money here and I put it to work up there. So I'm long for free-ish because I paid, I collected, net effect should be close to zero. Any money I collect from selling this, even if at a loss for this part right here, is pure profit because I didn't pay anything for it because I collected this stuff as long as price stays above my mark. Okay, so this is how I can play it. Now, I showed you fundamentals. The fundamentals are against this trade because bonds have been in a bubble, but they've been in a bubble for over a year. So how much weight would you give that to this trade in particular? Technically, it's at a decision point. Head and shoulders, bearish. We don't know if it's going to break or not. If it does, it's going to shoot to here. If it doesn't, it's going to bounce. So we've got fundamentals, technicals, and I just showed you how I would set it up. There are several ways of setting it up. I'm going to try and share a write-up of it. In fact, we can go look at some premiums right now and see if they're available. Okay, so this is a option chain for TLT, and it's currently down today, and I don't know what period of time. I picked February 9th. I don't know. Let's go January 26th. So we were talking at, let's bring back the levels now. The area I want to be long is 119-ish, not any closer than that, because in case this debacle happens, I want to see if I can hide behind it. Okay, so 119, well, there's not much premium there for that. So if I wanted to go longer, February 2nd, if I wanted to stay at the 119 area, I would have to go, let's go to 120 here. Okay, so this is not enough. 119 and a half could give me, let's see, 8, 10 cents. So I'm going to be around 120 in order to make some money. So I would sell the 120, buy the 119. This should give me 11, 12 cents, maybe 120 and a half in order to, what I'm looking for is enough yield on a $1 wide spread that is about 15%, 15 to 20% yield on my risk, meaning I risk 82 cents, let's say, to make 12, or risk 15 to make, risk 85 to make 15. So the bottom line is the yield is about 15 to 20%. Depends on how aggressive I want to get. It's small money that helps offset whatever call spread I want to buy. So this is where current price is now. Okay, so time-wise, I have to choose my timeline. It depends on preference, personal preference. I want it to end next week, I go here, but what happens then? I have to be so close to current price in order to get any premium. So my bet would be a high chance that I'm going to have to worry about it. If I go out in time, okay, there's more time for stuff to go wrong, but at least I have some breather room. So I can see something happening, I can adjust. I have time to react is basically what I'm looking at. So it's potato, whatever one person likes more than the other. I'm a low drama kind of guy, so I tend to want to go a little bit longer, a little bigger buffer. So I see an accident coming. It's like fighting the battle with binoculars from headquarters versus being in the trenches at the bottom, at getting all the glory at the front line demarcation zone. So I'd rather be way up there with the binoculars. This way I have time to react, and this way my thesis can develop and I can react to it, to the headlines that come here and there. So I'd rather go to, say, January 26th and February 2nd and do that. Now, the flip side of it is if I go to 125 to see the calls. All right, so how do I play on the call side? On the call side, I'll do the opposite. I will buy, this is, I could buy naked calls, but it costs me $100 one contract, basically. Or, if I wanted to go a little bit higher, it gets cheaper, but the chances of success get smaller and smaller. So what I can do is I can buy a debit call spread somewhere around here, $1 wide, 50-cent wide, $2 wide, depends on preference. And if price rallies, I double my money if I do it close to here. And I have 3 weeks for that to happen. Okay, so, but if I'm selling the credit put spread, my base is not zero, so doubling my money is really an understatement as long as price stays above that, right? Because I collect money to get from the credit put spread. me selling risk, me selling somebody insurance down there, and or losing a lottery ticket, and then I spend some of that money here. So my entry point is a little bit cheaper than what I'm paying, if not all free. So it all depends on what I end up with. So the idea is buy call spreads to be bullish, or sell put spreads to be bullish, or both at the same time. The thesis is technical, that, okay, we're going to get a bounce here rather than a breakdown. All right, if you have any questions, I'm here to answer them. Nick signing out.